Today we will be discussing in detail about what an asset is. This is one of the most fundamental terms in accounting that you must know. But before we go through all of that, I would like to welcome you all to Accounting Zero to Hero. We are here to help you understand the fundamental accounting concepts through simplified technical discussions and practical applications of the accounting standards. All of this to help you go from zero to hero. Now let's go back to the video. Today we will start off by looking further into the practical definitions of an asset. Then we'll investigate what the standards are telling us about it. Then lastly, we'll try to connect it to real-world examples by examining the financial statements of a well-known listed company. So, as you learn more about the accounting standards, you will encounter more and more different types of assets. But for now, I want you to focus on thinking that assets are everything, or every resource that the company, number one, has ownership of. Well, this becomes a little bit tricky when we talk about leases, but we will not cover that for now. An asset also is a resource that the company has a right to use. Or it may be a right to collect. Most assets that I know of are covered practically by this simple definition. So it really helps when you have this basic fundamental understanding of an asset even without looking at the standards. For example, imagine that you are a business. The cash in your bank account that you earned from your summer job is an asset. It is your asset because you earned it from hard work. Right now, it doesn't really matter if it is earmarked for payment to someone as long as you haven't paid them yet actually. The laptop, so I know this is a calculator, but for all of the things that you own, like your laptop or your phone that you are using right now, is your asset because you bought it or someone gave it to you. Also, remember that $50 that your friend owes you? It is your asset because it's something that should be paid to you in the future. It's actually an example of a right to collect. So those are a very simple examples of assets that I can think of. But right now, since we are in this slide, I would like to insert some personal finance tips that I want to discuss related to, for example, this screen. Please remember that your credit limit or your credit card is not your asset. I just want to avoid any misconception based on the slide that we used. So as an accountant and as a student, you know that some assets are more complicated than the ones that we mentioned in the previous slide. This is why we have standards that exactly define what assets are in case of confusion. And trust me, sometimes there is. As such, technical discussions can be found by reading two main sources about assets. Number one are the Conceptual Framework of Accounting. The second one is the IAS 1 Presentation of Financial Statements. We will be discussing both of these in detail in the succeeding slides. So, the definition of an asset is covered in Chapter 4 of the Conceptual Framework. A full text of the Conceptual Framework is provided in the description as a link. In Chapter 4, you will find that an asset is one of the 5 main elements of a financial statement. The first one being the asset. Second one is the liability. Third one, equity. Fourth, income. 5, expenses. The other 4 will be discussed in the future. You will also see that the asset is the only element of financial statement that relates to resource. This is why in the practical definition, we discussed that it is everything or every resource that a company owns, has a right to, or has a right to collect, because these are the resources that the company owns, as opposed to being claims or changes in resources and claims. With regard to the technical definition of an asset, according to the conceptual framework, it says that an asset is a present economic resource controlled by the entity as a result of past events. An economic resource from this basic definition is then further defined by the conceptual framework by saying that an economic resource is a right that has the potential to produce economic benefits. From the definition, you will see that there are three main characteristics of an asset. Number one, it is a right. Number two, it has the potential to produce economic benefits. And lastly, it is controlled by the entity. All of these things will be discussed in detail. So let's start off with the right. Rights that have the potential to produce economic benefits take many forms, including, number one, rights that correspond to an obligation of another party. There are four things that were enumerated in the conceptual framework to exemplify this. First one, rights to receive cash. Second one, right to receive goods or services. The third one, right to exchange economic resources with another party on favorable terms. Again, right to exchange economic resources with another party on favorable terms. The fourth one and the last one, right to benefit from an obligation of another party to transfer an economic resource to you if a specified uncertain event occurs. If you're taking an exam, it's better to memorize all of these four since these are specifically stated in the standard. The second one are the rights that do not correspond to an obligation of another party. There are two things that were enumerated here. Rights over physical objects. And lastly, rights over intellectual property. The second one is pretty straightforward because they do not correspond to obligations of another party, meaning that if you have bought a property, for example, and then the goods have already been delivered to you or the service have already been rendered to you, the obligation of the other party ends with that performance of the service, and your right on the asset is already on how you're going to use it to produce economic benefits. We also have to remember that many rights are established by contract or legislation, so that you can actually have a right on a particular asset even if it's not a tangible asset. For example, what we're saying here is intellectual properties like patents. The second one is the potential. The keyword here is use. By using the asset, an entity has the potential to, number one, receive contractual cash flows or other types of economic resource. Number two, exchange economic resources with another party on favorable terms. Number three, produce cash inflows or avoid cash outflows. For example, this one can be done indirectly through the property, plant, and equipment. If your PPEs or property, plant, and equipment are used to produce inventories that you're selling, you're actually indirectly producing cash flows from the asset. So it doesn't have to always be direct. Number four, you have the potential to receive cash or other economic resources by selling the economic resource. And number five, You can extinguish liabilities by transferring the economic resource to another party. The perfect example here is payment through cash. You also have to remember that for this potential to exist, it does not need to be certain or even likely that the right will produce economic benefits. It does not need to be certain. It is only necessary that the right already exists, and that in at least one circumstance. It would produce for the entity economic benefits beyond those available to all other parties. What we mean here is that even if there is a low probability of realization, it is an asset still. However, you have to remember that a low probability might affect decisions about what information to provide about the asset and how to provide that information, including decisions about whether the asset is recognized or not. Because if you're still going to recognize an asset with a low probability of realization, you might deceive the users of the financial statement that you still recognize the asset. So it's going to be a little bit tricky on certain types of assets, but the conceptual framework has put it out there that it does not need to be 100% certain that the particular asset is going to produce economic benefits for you. For example, I think the perfect example I can think of here is, again, on the property, plant, and equipment. You're still recognizing this as an asset because it indirectly produces inventories for you. But you have to question yourself that, is it sure that your inventories will be producing cash flows, or is it sure that your inventories will be sold after 2 months? The answer is no. But you're still recognizing your inventories as an asset and your PPE as an asset, even though it is not very certain whether they're going to be sold in the future. Of course, your inventories, if it goes through a specific value, if the value of the inventory goes down as per IAS 2, which is a little bit more advanced right now, you have to do some measurement exercises. But the inventories are still valid assets. That's the point of the conceptual framework. The last one is the control. You have to remember that control links an economic resource to an entity. Assessing whether control exists will help you identify the economic resource for which the entity accounts. Why? Because, as you know, everything is actually a resource, but not everything is your resource. So you have to only account for resources that are yours. What does the conceptual framework say about control? It says that an entity controls an economic resource if, number one, it has the ability to direct the use of the economic resource, and number two, if it has the ability to obtain the economic benefits for itself. So number one is to direct the use, number two, to obtain the economic benefits that may flow from it. If you cannot really obtain the economic benefits, then you have to question whether the asset is yours or not. And with that discussion on control, that about wraps up the discussion on the conceptual framework regarding the assets. So, as a recap, for a resource to be considered your asset, you should have a right to it. It should have a potential to produce economic benefits, and you should be able to control. And you should be able to control the use of the asset, or to obtain the economic benefits that may flow from it. Is an and not an or. It's important to remember. Now we move on to the coverage of IAS 1. The standard, on the other hand, does not provide us a definition of an asset, but it tells us the presentation requirements of how assets should be presented in the financial statements. It says that an entity shall present current and non-current assets as separate classifications in its statement of financial position, except when a presentation based on liquidity provides information that is reliable and more relevant. IAS 1 speaks about the terms current and non-current assets, and these have been defined for the first time in this particular standard, so it's important that you know about these two terms. An entity shall classify an asset as current when, number 1, it expects to realize the asset in its normal operating cycle. What is the normal operating cycle? This is the time, we're going to put it here. This is the time in between the acquisition of the asset and the realization in cash. For example, if you're buying inventories or buy and sell, and then you're expecting to sell these inventories to the customers in cash in about 2 months, it means that your normal operating cycle is 2 months because that is the time when you are converting your inventories into a sale. If the period is not very clear on the business, and even in your exams, it is assumed to be 12 months. And that's according to the Conceptual Framework. So the second one is when the asset is held for trading. What is a held for trading asset? It is normally a security or an investment that you purchase with the intent of selling within a short period of time. Within short period of time, normally within 1 year. So if you have an intent of selling it and you don't know when, normally within 1 year, sometimes within days, it is held for trading. And it is always a current asset, and it's held at fair value. This part actually primarily relates to assets that are bought or sold in formal exchanges like the stock exchange. The third one is when you expect to realize the asset within 12 months after the reporting period. The third one is actually very different from the first two, in a sense that this one covers all other assets. Even if you're not in the business of buying and selling land, for example, but you hold land for capital appreciation, but you are planning to sell the land that you are holding within 12 months after the reporting period, then this will be considered a current asset. The fourth one and the last one is when the asset is a cash or a cash equivalent as defined in IAS 7 and it is unrestricted. So that's pretty straightforward. IAS 1 gives us a very broad classification of a non-current asset. It says that all other assets are non-current. So if it does not fall on the first 4 definitions above, the asset is considered as non-current. In the next few slides, we will be talking about some common examples that we have already discussed before. Common examples of current assets are discussed in the slide. The first one are the trade receivables. These are the rights to collect that we have discussed in the earlier slides. These are the right to collect from the customers that we have because they bought through credit. Meaning that they bought the goods and services that you're selling, but they didn't pay it yet. Cash and cash equivalents. These are specifically defined by IAS 1 as current, unless restricted. The inventories. These are normally realized. Within normal operating cycle. That's why they are still current. Advance payments, these are the prepaid expenses, which means that you already paid for the service, but the service has not yet been rendered to you. It's an asset because it's a right to receive goods and services as defined in the conceptual framework. Common examples of non-current assets are PPE, or the property, plant, and equipment. These are non-current because you are expected to use it for more than 1 year. For example, if you have a building that you are using to produce your goods and services or your inventories, you are expected to get benefit from your building for more than a year, maybe even 10 years or 5 years. Deferred tax assets are specifically defined by IAS 1 as non-current. They will never be a current asset. This is covered by IAS 12 on income taxes. Long-term loans receivables, as even stated in the name, it's long-term. These are actually still right to collect. But the right to collect extends for more than 1 year. For example, if this is your reporting period of 12 months, and you're preparing a financial statement as of the year end, year X, and this is year X plus 1, this is year X plus 2, and you're expected to receive this receivable at this point in time by contract. There should be a contract. Then this is a long-term loan receivable. So one thing to just think about, if after 1 year, you're going to report as of this period now, it's going to be a short-term loan receivable now because you're expected to collect it at this point in time. Properties held for rental are actually the same thing as the PPEs with a different type of nature. But since these are properties held for rental to others, you're expected to rent it for more than 1 year to get the benefit from these fixed properties, fixed assets. Except that this one is being rented to others. This one is being used yourself. So the first one is being used by the company itself, the other one is being used by other parties, and you're just collecting cash flows. But both of them are non-current assets unless you have decided to sell them within 12 months after the reporting period, in which case it falls into the definition of a current asset as per IAS 1. So when I was still starting my studies, I often wonder if the things I am learning is applicable in real life. This is why I wanted to include the last section here, where I check the latest financial statements of a listed company to see the actual applications of what we discussed. For now, I was able to obtain the 2019 financial statements of Tesla to look at their assets. So for now, you will see that this is the balance sheet or the statement of financial position. You will see that we always present two periods in the statement of financial position as a default. And as per the discussion that we have, it's quite curious that yes, they classify their assets as current and non-current assets. Inside their current assets, they have the normal types, cash and cash equivalent, account receivable, inventory, prepaid expenses. These are the advance payments that we talked about. It's quite curious for me that they have a restricted cash in the balance sheet, but you have to take note that that is the current portion of the restricted cash. Maybe the restriction will be lifted within the next 12 months. That's why it's still qualified as a current asset. Remember that this balance sheet has already been audited. So they have the non-current portion of the restricted cash in their non-current assets. So as you can see, all other types of assets, all of the more complicated assets per se, are actually in the non-current assets because as per IAS 1, all other assets are classified as non-current. They also have some intangible assets here. Such as goodwill. And that about wraps up our discussion on the assets based on practical definitions, the conceptual framework, and the IAS 1 definitions of current and non-current assets. I hope that you learned something from this discussion. For the next video, we will look into the rest of the elements of the financial statements. So make sure to subscribe and hit the notification bell to keep yourself updated on the channel. See you!